Hey everyone, and welcome back to Tech Fails. If you were around during the late 90 seconds, the buzzword wasn't the cloud, it was fiber optics. Specifically, a massive, shimmering, invisible empire of glass cable laid under the deepest oceans, connecting every continent. This wasn't just a new kind of internet. It was the digital circulatory system of the entire planet, and the company promising to build it, the one that burned brighter and faster than almost any other in the dot-com era, that was Global Crossing. Picture this, a startup barely 5 years old with over $20 billion in assets, a market cap that hit nearly $47 billion, and an executive suite filled with guys who were treated like gods. They were the masters of the universe, selling the future of connectivity. But here's the fail. Global Crossing never had a profitable year. Not one. It was all a mirage, an illusion built on thin air and aggressive accounting practices. It was a scheme designed to inflate revenue so masterfully that the whole system ultimately snapped under its own weight. This financial engineering was a key moment in technology scandals history. This is the story of how an engineering marvel became the fourth largest U.S. bankruptcy in history, and the scandal that changed how we look at balance sheets forever. To understand the fail, you first have to understand the dream they were selling. The mid-1990 seconds were truly the Wild West of the internet age. Everyone knew the internet was the future, but the infrastructure to support it was ancient and inadequate. We were essentially trying to run a supersonic jet on old dirt roads, and the primary bottleneck wasn't the computer itself, it was the pipe. That crucial connection speed and capacity was the limiting factor holding back true digital progress. Enter Gary Winnick. He was a former high-level executive from Drexel Burnham Lambert, a true master of high-stakes finance and, perhaps more importantly, an incredible master salesman. In 1997, Winnick founded Global Crossing with a singular, audacious, and monumental idea. That idea was to lay a truly global, interconnected network of undersea fiber optic cables. This wasn't just connecting North America and Europe, which was already happening, but linking across the Pacific down to South America, touching every major continent and city. He optimistically called this monumental undertaking a ring of light. It was a genuine technological feat, requiring billions of dollars and massive, specialized ships to spool out glass cables into the deep sea. A truly colossal undertaking. Winnick's pitch was absolutely intoxicating to investors and the market. He promised potential investors that the demand for digital bandwidth would double every 100 days, a statistic that was, in hindsight, wildly exaggerated. Wall Street, however, ate it up like it was gospel. The company began raising money faster than almost any startup you can name even today. By the time the dot-com bubble hit its inevitable peak, Global Crossing had successfully secured $10 billion in debt financing. They also managed to raise over $40 billion in equity from excited investors. The concept seemed simple enough. Whoever laid the most high-speed pipe first would effectively control the future of the internet itself. Their stock price soared almost uncontrollably. Winnick himself sold hundreds of millions of dollars of stock before the eventual collapse. A crucial detail we must not forget. Global Crossing's core product was selling something called indefeasible rights of use, or IRUs. Think of an IRU as buying a very long 20-year lease on a dedicated piece of capacity, a specific slice of the digital pie on their super-fast global network. Selling these long-term leases was the only possible way to fund the staggering multi-billion-dollar cost of laying all that fiber. But here is where the technological dream starts to dramatically collide with the harsh economic reality facing them. The fatal flaw in their entire business model was the simple concept of oversupply. Everyone else in the telecom sector had exactly the same ambitious idea as Winnick. Suddenly, the telecom landscape was completely flooded with companies racing to lay their own fiber, including WorldCom, Quest, and Level 3. They were all building their own digital freeways simultaneously. When every company builds a massive freeway for the internet, you inevitably end up with a huge amount of oversupply. There was far more total capacity than the market actually needed. Instead of a highly sought-after scarcity that commanded premium high prices, the bandwidth market rapidly became a buyer's paradise. The price for even a large slice of bandwidth collapsed dramatically. Global Crossing's projected massive revenue stream quickly became a frighteningly small trickle. The debt service alone, just paying the interest, was $600 million a year, and they were nowhere near approaching profitability. The empire of light was now becoming an empire of empty, dark fiber, lacking paying customers. The executive team, still led by Winnick, was now facing a truly terrifying reality. They had a crushing debt load and revenue that was falling off a cliff quarter after quarter. To Wall Street, a tech company that couldn't demonstrate explosive growth was considered nothing less than a failed company, and they were desperate. They had to find a way, any way, to make the quarterly numbers look good on paper. They needed a way to creatively invent revenue, to spin the story for investors. This is precisely where the Global Crossing scandal moves from a mere business failure into a full-blown financial catastrophe. The most insidious and now famous accounting trick Global Crossing used to pull this off was known as the capacity swap. It worked like a magical but fraudulent shell game to deceive auditors and investors alike. Let's look at a simple, real sale first. Global Crossing sells a 20-year IRU to an actual client for $100 million. They get $100 million in cash, and they correctly book that as revenue. That's perfect, clean accounting. Now, let's look at scenario B, the fraudulent capacity swap. This is where the true accounting magic, or rather the fraud, actually happened. Global Crossing would approach a primary competitor, let's use QS Communications as an example, and propose a deal. They would say Global Crossing sells Quest a $100 million IRU on its newly laid fiber network. Then, almost simultaneously, Quest sells Global Crossing a corresponding $100 million IRU on its own fiber network. Now, you have to pause and think critically about this arrangement for a moment. No new capacity has been added to the overall market through this deal. Furthermore, no net cash has actually changed hands between the two companies. Both companies have simply swapped two equally valued pieces of a network that already has way too much capacity to begin with. It's essentially a digital handshake with absolutely no commercial benefit or real economic purpose. But the crucial part was the accounting, as advised by their auditor, Arthur Andersen. Yes, that is the same Arthur Andersen who was fresh off the catastrophic Enron scandal at the time. This accounting advice allowed Global Crossing to treat this circular transaction in a way that created a massive, purely fictional burst of reported growth. This was the deceptive core of the scheme. Here is how they booked it. Global Crossing booked the $100 million sale to Quest as revenue. Up goes the quarterly earnings report to look fantastic. This satisfied the analyst's need for growth. Simultaneously, Global Crossing booked the corresponding $100 million purchase from QWest as a capital expenditure. This purchase was conveniently an investment in future assets, which is off the quarterly income statement. Therefore, booking it as a capital expenditure didn't hurt the all-important operating results they presented to the public. It was essentially round-tripping revenue to manufacture growth that simply did not exist. They were essentially selling capacity to themselves, or at least to a friendly partner who was simultaneously selling it right back to them. This created a massive circular flow of fictional money. This flow only existed for one purpose: to meet Wall Street's completely unrealistic quarterly growth expectations. The pressure for growth was what fueled the deception. In the first half of 2001 alone, Global Crossing booked a staggering $720 million in cash revenues just from the sale portion of these capacity swaps. This was not real demand from real customers, folks. This was just aggressive paperwork and financial manipulation, a digital game of hot potato designed solely to give the convincing illusion of a rapidly expanding, successful business. It was pure financial engineering. Internal company documents later surfaced and revealed that the specific dollar values of these capacity swaps were often remarkably fluid and changeable. They could be set as necessary to bridge the gap in their ability to hit their predetermined revenue targets. This wasn't a sustainable technology growth model. It was financial engineering masquerading as true technological success. They were cooking the books to keep the narrative alive. As the internal reality worsened with massive debt and a complete lack of real customer demand, you must ask, what were the executives actually doing? The answer is simple and infuriating. They were cashing out their shares. Between 1998 and 2001, founder Gary Winnick personally sold off nearly $734 million in company stock. That's a massive amount of personal profit. Other high-ranking executives at Global Crossing unloaded an estimated $900 million more in shares during the same period. They were actively selling off their stake in the company that was supposedly on the verge of dominating the entire global telecom market. This wasn't just opportunistic selling, which can be common. To many observing the situation, it looked like a clear and conscious indication that the people who knew the truth about the poor business fundamentals had decided it was time to abandon the ship. The total insider trading in Global Crossing, the amount of money the executives pulled out, actually exceeded the insider trading at Enron during the same exact period. Let that shocking fact sink in for a moment. The regular employees, meanwhile, were often strongly encouraged to invest their 401(k) retirement funds heavily in company stock. Due to vesting rules, these employees often couldn't sell their shares for years, essentially trapping their life savings. They were tragically left with worthless shares when the whole thing finally collapsed, losing their hard-earned retirement savings. The top brass, meanwhile, had walked away with multi-million-dollar fortunes. The entire house of cards began to wobble precariously in 2001, just as the wider tech bubble was bursting. One of the first brave people to speak out publicly was former Vice President of Finance Roy Olofson. Olofson formally raised serious internal concerns with the company lawyers about the improper accounting related to the capacity swaps and the constantly inflated revenue figures. He was ignored. Initially, Global Crossing and its CEO, John Legere, denied all of the allegations of improper accounting, loudly and repeatedly. Legere, ironically, later went on to become the very successful, outspoken CEO of T-Mobile. They claimed the controversial transactions were perfectly lawful, done in full consultation with Arthur Andersen, and represented only a small part of their total revenue. The whole industry was using swaps, they argued, and it was all completely above board. But the combination of overwhelming, crushing debt, a market drowning in unused dark fiber, and the public accusations of fraud was ultimately too much for the company to withstand. The company's financial solvency was completely gone. In January 2002, just 1 month after its fellow fraudulent traveler, Enron, went under, Global Crossing formally filed for Chapter 11 bankruptcy protection. It was the moment of reckoning. At the time of filing, with $22.4 billion in assets and $12.4 billion in massive debt, it instantly became the 4th largest bankruptcy in U.S. history. The magnificent dream was officially over. The Empire of Light was now drastically reduced to nothing more than a giant, financially toxic pile of unused assets. The aftermath was absolutely devastating for investors and the global technology industry. It was most devastating for the thousands of hardworking employees who lost their jobs, their severance packages, and heartbreakingly, their retirement savings all at once. The collapse of Global Crossing immediately triggered intense investigations by both the Securities and Exchange Commission and the FBI. They wanted answers about the financial deception. The investigation primarily centered on the nature of the capacity swaps and the illegal practice of recognizing the long-term IRU contracts up front as immediate revenue. This was done instead of recognizing the revenue slowly over the life of the 20-year contract, which is standard, proper accounting practice. This technique of accelerated revenue recognition was designed solely to create an immediate, artificial financial boost for the company. Ultimately, no executive faced criminal charges for the actual accounting fraud itself, a major point of public controversy at the time. However, the company and its executives did face severe penalties and civil action lawsuits. In 2004, Global Crossing emerged from bankruptcy after being acquired by Singapore Technologies Telemedia and Hutchinson Whampoa. Crucially, the original stock and debt investors who had poured billions into Winnick's vision were virtually wiped out. They lost everything they had invested in the dream. Also in 2004, Gary Winnick and other former executives agreed to a major settlement in a class action lawsuit filed by those hurt investors. They paid back $325 million though. Winnick maintained no official admission of guilt regarding the fraud. The failure of Global Crossing, alongside the twin failures of Enron and WorldCom, was a profound moment of national economic crisis. It was not a flaw in the fiber optic technology itself. It was a massive flaw in corporate governance and basic honesty. The primary business failure wasn't the product, because fiber optics did ultimately become the backbone of the internet, just as promised. The spectacular failure was the irrational exuberance and the belief that demand was limitless, which would magically bail out any amount of debt. The market for bandwidth was always a finite, competitive resource, not a perpetually expanding goldmine. Ambition is never a substitute for true financial fundamentals or ethical reporting. Global Crossing's greatest lesson is about transparency and severe accountability in finance. The capacity swaps were merely a financial innovation used to mask the simple truth. There were no organic profits or real customer demand. They relentlessly chased fictional revenue only to keep the stock price artificially buoyant long enough for insiders to profitably cash out. This era of widespread fraud led directly to the passage of the Sarbanes-Oxley Act of 2002. This was a sweeping regulatory reform designed explicitly to prevent executives and auditors from playing fast and loose with financial statements ever again. That is the true legacy of this failure. The Global Crossing network eventually found its footing under new, more responsible ownership, emerging from bankruptcy to become a functioning, vital part of the global telecom infrastructure. The technology itself was perfectly sound and brilliant. The business model and the ethics of the people running it, however, were absolutely not. They built the rings of light as promised, but they tragically left us all with the darkness of a massive, completely avoidable tech failure and financial scandal. And that's the story of Global Crossing, a crucial case study in how far corporate greed will go just to successfully hide a simple, fatal lack of actual paying customers. It reminds us that sometimes the biggest threats to a technologically brilliant idea aren't a competitor or an engineering flaw, but the guys counting the money. Did you lose money in the dot-com bubble? Have a friend who worked at Global Crossing? Let me know your story in the comments below. If you want to see another story of telecom titans collapsing under their own hubris, make sure to like this video, subscribe to Tech Fails, and click the notification bell. We'll see you next time for another story of ambition, innovation, and total catastrophe. Peace out.